The strong growth in recent years of oil production in the United States and Canada is coming under increasing threat from a shortage of pipeline capacity. In short, it's a simple case that output has risen faster than the pipelines can be built to take away the increased production to areas where it can be either refined or exported. And the situation has been made worse in a number of important instances by delays to propose new pipelines. The shortage of takeaway capacity is depressing the price of crude across the whole of North America. As we've previously spoken about, the principal reference crude, West Texas Intermediate or WTI, in terms of quality ought to be trading at a premium to the international market grade Brent, but has been at a discount of up to $10.50 during 2018. Canadian crudes, which we've also spoken about previously, have suffered the same fate as their price has been closely linked to that of WTI. Attempts to circumvent the shortage of pipeline capacity in both countries have included increasing the volume of oil transported in railway tankers, by barge and coastal tanker, as well as, in a few instances, by road. Understandably, all of this increases transportation costs, which inevitably depress the price received at the wellhead by producers. While these methods of transport have proved a useful addition to takeaway capacity in parts of the US and Canada, they are at best a short-term solution to the shortage of pipelines. There have been proponents to say that rail may take up some of the slack, but rail transport itself has faced problems over the longer term, including a series of accidents, including one that killed 47 people and destroyed part of a Canadian town in 2013, and a number of smaller accidents in both Canada and the US. Pipelines, therefore, remain the only long-term answer to the shortage of takeaway capacity. You might be asking, though, why a sudden requirement for this increased capacity? Well, between 2007 and 2018, oil production in the US and Canada has risen strongly. In the case of the United States, it's gone up by nearly 8 million barrels per day, or 116%, from 6.8 to 14.8 million barrels per day. And that itself masks the true growth rates, because most of the growth in production has occurred since 2011, of course giving therefore little time to build new pipelines to handle this increased oil flow. It should come as little surprise that the rapid growth in US production has been driven largely by shale oil production, particularly in Texas, which contains 3 of the 7 main shale formations, namely the Permian Basin, Eagle Ford, and Haynesville. Shale oil production accounts for over 70% of the total US crude production of 10.6 million barrels per day. Consequently, the most serious shortage of pipeline capacity is in Texas, and in particular the Permian Basin. At the beginning of 2018, spare takeaway capacity in this region was estimated to be only 160,000 barrels per day. Now it's effectively full. While oil producers can occasionally find small amounts of pipeline capacity on a temporary basis, they have to pay a high premium for it. Otherwise, they've got to resort to rail transport or road tanker. As with all laws of supply and demand, the result has been a sharp fall in the wellhead price of crude. Looking at the physical flows, therefore, most of the crude produced in the Permian Basin is sent either to the Gulf Coast, where it's refined or exported, or to the main US pipeline hub at Cushing, Oklahoma, from where it's piped to the main refining regions of the mid-continent. The pipeline bottlenecks and the low prices that go with them are causing problems for producers in the west of the state. While the problems principally affect crude oil, a shortage of takeaway capacity for natural gas has also caused production to fall in some cases. This feedback loop means that pipeline bottlenecks are beginning to slow down the rise in crude oil production as some producers delay well completions. In a number of cases, producers in the Permian are removing rigs to other shale regions that are less capacity constrained in terms of pipelines, such as Bakken Shale in North Dakota and Montana. We must remember that one of the highly important factors in prompting the rapid recent growth in US production of both oil and gas products is the liberalisation of crude oil exports in late 2015. Restrictions on crude oil exports were brought about in the 1970s to improve US energy security at a time when its production was falling as imports were rising along with global crude prices. The inability of US producers to export, other than mainly to Canada, led to an oversupply of light sweet crude such as WTI in the domestic market, depressing its price against that of the principal international crude market of Brent. WTI's physical characteristics and increased distillation yield ought to give it a small premium. Most analysts say around $1 to $3 a barrel against Brent. This was the case in 2008, after which the US crude fell to a discount of over $16 a barrel against Brent. Since 2015, US crude exports have risen sharply and the differential has thus narrowed, most recently to around $5 to $6 a barrel. It is clear, though, that from WTI's continued discount to Brent, US producers are not obtaining the full potential value of their output. Pipeline bottlenecks undoubtedly play a significant part of this, but there are two other factors affecting exports. The first is a shortage of terminal capacity on the Gulf Coast capable of accommodating the largest size of oil tankers. And the second, as always, is political. The largest buyer of US crude is China, and producers in Texas had high hopes of selling more there, but crucially this is being put at risk by the reimposition of tariffs by the US government. Beijing, to counteract, has also begun imposing surcharges on some US exports. The hope in Washington was that any fall in Chinese crude purchase from the US would be more than offset by a rise in US crude exports to other parts of Asia. But countries there take a much lower volume than China. And although exports to the rest of Asia look set to increase as some countries seek replacement barrels for the Iranian supplies lost at the start of November, the potential for large increases does not appear to be that high. The growing number of supply outages and political disruption around the world is causing the oil market to become a lot more volatile, putting extra emphasis on every barrel it does or does not make it to market. This makes the infrastructure bottlenecks in West Texas a global concern.